Good evening, Company Registrar Ms. Tang, our distinguished speaker, Professor Fox, ladies and gentlemen, welcome to the fourth IFO Company Registry Distinguished Lecture in Corporate Law and Governance. I'm Say Gu, Professors of Law and former directors of IFO, which host the event today. In 2015, through the effort of the then Company Registrar, Ms. Ada Chung, and myself as the then directors of IFO and Company Registry signed an agreement to fund a series of distinguished lectures in corporate law and governance. The first lecture was delivered by the 2007 Nobel laureate, Professor Eric Maskin from Harvard University. The second was delivered by Professor John Coffey from Columbia Law School. The third was delivered by Professor Roberta Romano from Yale Law School. And tonight we're extremely pleased to have Professor Murray Fox from Columbia Law School to deliver the fourth lecture, which was originally scheduled for 2019, but was postponed several times due to the social unrest in 2019 and the COVID lockdown after that. So it's taken a long time, and we're all very happy that Professor Fox is finally here to deliver the long-awaited lecture. But before that, may I take this opportunity to thank the Company Registry for its generous donation and to thank our company's registrar, Ms. Tang, and her team for their efforts and support, which makes this series of distinguished lecture possible. We at IFO treasure very much the relationship with the Company Registry, and our collaboration over the past decade has, I believe, benefited the universities and the community here in Hong Kong. So for that, we are all very, very grateful. Before I invite the speaker to speak, may I first invite Ms. Tang to say a few words.
Professor Fox, Professor Gu, ladies and gentlemen, good evening. It is my great pleasure to join you here this evening. We are indeed very honored to have Professor Fox with us today to share his valuable insights on foreign ownership and corporate governance. As a leading international financial and business center, Hong Kong attaches great importance to corporate governance. For companies to be successful, competitive, and sustainable in the long term, good corporate governance is the key. A high standard of corporate governance is also crucial for maintaining the credibility, stability, and competitiveness of our financial market. Over the years, the Institute has played a significant role in raising the awareness of the importance of upholding a high standard of corporate governance through research projects, conferences, lectures, and so on. I must thank Professor Gu and the Institute for the great efforts in organizing this series of lectures since its inaugural lecture in 2016, which allowed us to keep abreast of all the latest developments of corporate law and governance in other jurisdictions, stimulate discussions on issues relating to the management and governance of companies, which in turn help raise the standard of corporate governance in Hong Kong. Now that the COVID pandemic is over, I'm very glad to witness the resumption of this series today. Ladies and gentlemen, I wish you all a very rewarding and enjoyable evening. Thank you.
Thank you, Ms. Tang, for your wise words. Let me now turn to our distinguished speaker tonight. Professor Fox needs no introduction. He's Arthur Levitt Professor of Law at Columbia Law School and has taught at Yale and Michigan Law School, among others, prior to that. He holds a JD in law and a PhD in economics, both from Yale University. So he has been able to look at corporate governance and security regulations from not just the usual black letter law perspective, but also from the economics perspective, giving us a better understanding of how economics affects law and how law may in turn affect economics, and how to formulate regulation that would achieve greater efficiency and fairness at the same time. Tonight is going to analyze the growth of cross-border or foreign share ownership and its impact on corporate governance of the issuer, a very pertinent issues in all major stock markets, including Hong Kong. Again, from a law and economic perspective. So with that, may I invite Professor Fox to address us.
Well, thank you very much for that kind introduction, Professor Gu. So my subject tonight is the relationship between the rise in foreign ownership, which we've witnessed over the last several decades, and changes in the kind of quality of corporate governance, which also, I think, as a general perception, has improved in recent decades. So I'm going to basically try and do four things this evening. One is simply to document the rise in foreign ownership, which when you look at the data, you're going to see is really quite dramatic over the last few decades. Second, try to put that rise in context. Ultimately, what we want to look at is the relationship between that rise in corporate governance, but there are other factors that help explain that rise as well, and in fact, I think form a catalyst in a sense for the rise in corporate governance. What I want to do is look at in essence, the forces that tend to encourage cross-border ownership, the ones that impede it, and I think we can explain the significant part of the rise in foreign ownership by a diminution in the forces that impede. Then I want to talk a little bit about understanding kind of the causal pathways between the observed relationship between the extent of foreign ownership of companies of any given country and its corporate governance. It suggests that the relationship is well established empirically. I'm going to suggest that there are kind of causal factors going in both directions. And finally, to suggest that in some sense there's been a quiet revolution going on, that we've seen this continuous growth over the last 3 decades in foreign ownership, these changes in corporate governance, and maybe really changing the world, but also asking the question, will it continue? So let's just start to document the changes we've seen. So if we go back 30 years, 3 decades, we can see this is just kind of the United States versus the rest of the world, but only 6% of all the equities owned by US investors at that time were in stocks of foreign issuers. And then if we look over here in this box, only of the holdings of non-US investors, that only 3% of those were in US issuer stocks by value. So if we flash forward almost 30 years, there's a dramatic difference. Now we see that US, about a quarter of US shareholders' portfolios, equity investors' portfolios are in foreign issuers, and about 18% of non-US investors' portfolios are invested in US securities. So, in essence, then, the portion of non-US equities in US stock, US portfolios is more than quadrupled. The portion of US equities in the portfolios of non-US investors has gone up sixfold. And if we look kind of country to country around the world at a more kind of granular level, we're going to see the same kinds of dramatic changes. So kind of the bottom line figure here is that 42% of the capitalized value of all the corporations in the world, publicly traded corporations, is owned by somebody other than the nationality of the issuer. It's a big change. So, first of all, what I said is I want to kind of look at the non-corporate governance part of the story. Ultimately, I think that non-corporate governance part of the story is also a part of the corporate governance story, because I think it forms a kind of a catalytic role. But let's just kind of understand first these other forces. And I want to do that, as I said, by thinking first, what are the forces that would tend to promote cross-border ownership? What are the ones that would tend to impede it? And then explain what's happened over these last 3 decades in terms of the diminution of the forces, the impeding forces. So, one force is, there are differences in countries. Some countries we might call savings rich and others savings poor. That isn't just a matter of being rich or poor or having a high savings rate or a low savings rate. It's kind of how much savings do you have relative to the investment opportunities in your country. So, if there were no cross-border flows of capital, we would see different rates of return. Savings poor countries would have higher rates of return on investment than savings rich ones. That obviously forms a force then for trans-border investment in a kind of a win-win situation. Investors get from the savings rich country get higher returns. The recipient countries get more capital. That obviously kind of drives things in one direction, from savings rich to savings poor. But there's another force, the advantages of diversification, which in essence drive capital flows, share ownership purchases across borders in both directions. And the underlying idea here is, as a general matter in terms of portfolio construction, in essence, the more independent the forces determining the future cash flows of the different stocks that you have in your portfolio, the more independent the forces that kind of influence those cash flows from one issuer to another, the more that some significant part of the risk when you put a portfolio together can be eliminated through kind of a canceling out effect. Canceling out occurs because you can't know. Current stock prices basically reflect best guesses about future cash flows. Sometimes it's overestimating, sometimes it's underestimating. If if the forces affecting one company versus the other are independent of each other, they'll tend to cancel each other out, reducing risk. And, basically, issuers from different countries differ from each other more along this dimension. So it suggests there's a desirability then in what you might call transnational, having a transnational portfolio if you are an investor. This is something, as I say, would drive things in both directions. So now let's take that learning and kind of engage in a thought experiment of what you might call the ideal portfolio passive investor. So somebody who doesn't think they can pick stocks, find winners and losers or whatever, simply wants to invest some portion of their wealth in equities. Well, the learning from portfolio theory is the ideal portfolio would be basically a market-weighted portfolio of all the different publicly traded stocks in the world, weighted according to their market capitalization. And that would be true for every investor anywhere in the world. This ideal portfolio would be the one would, in essence, minimize risk for any given level of expected return. And since most investors don't like risk, do like expected return, that's the ideal portfolio. Say some countries are savings rich, others are savings poor. The savings rich countries, the investors there would simply have larger portfolios relative to the market capitalization of that country's issuers, but everybody would have the same mix. The consequences of this, kind of almost, mind-blowing, right? It would mean basically that, let's say US and Japanese investors would have the same mix. So that would mean both of them would have 7%, according to today's figures, 7% of their portfolio in Japanese equities, 43% of their portfolio in US equities. And, if you again think the world was constructed this way, it would mean every corporation in the world would be foreign owned. So each US corporation would, for example, have 55% of its shares owned by non-US compared to 22%. Each Japanese corporation, for example, would have 93% of its ownership compared to in foreign hands compared to percent today, including 45% of its ownership coming from US investors compared to 15%. All right, so those are the forces so far that we've looked at that would push towards a lot of foreign ownership. Why don't we see that? And why do we see more today, at least, than we used to see? Well, that requires an examination of the impediments and the non-corporate governance impediments for now. And I think I kind of break this into three categories, and I'll talk a little bit about each of them. One is that information concerning a country's issuers tends to be concentrated at home. Examine what I mean by concentration in a moment. There are also currency exchange risks associated with holding securities of another country, and taxes and regulations can create impediments as well. Let's talk about each of these, starting with this concentration of information. And then here I want to look both at passive investors, the people I have talked primarily about so far, and also active investors, people who are trying to find undervalued stocks to buy and sell and engage in sales of what they regard as overpriced stocks. So let's look at the passive investors first. So the underlying idea here, I think, is that passive investors, yeah, they're told to diversify internationally and so on, but they have a certain kind of familiarity and confidence in the pricing of the securities that they hold, and that tends to make them look at home first. You know, this faith and familiarity and kind of positive experience of seeing it's paid off before arises most easily in a domestic context. And so that creates, in essence, in portfolio composition. One, in some sense, we saw in extreme forms back in 1993, and still in substantial forms in 2020, and the data that I showed you. Now, what about speculative investors? These are people who pick stocks based on their individual beliefs as to the value of the future cash flows that are going to come from the stocks that they pick. And those beliefs are based on information and their kind of understanding of that information. If you're going to be a winner as a speculative investor, you've got to have information or an understanding of information that is better than most other people, because most people's understanding is already reflected in price, and you're looking for situations where, in essence, price is wrong. And that obviously then is going to call for concentrating buying and selling in equities of issuers about which you start with a natural information advantage. And where is that? Well, it's going to be in issuers of your home country, and let's see why that would be. And really, pretty simply, it comes from the lower cost of acquiring information and about the forces that affect the future cash flows of your own home country issuers versus the forces that affect those of foreign issuers. Well, we've all been around for a little while, and one of the things that's pretty obvious is that this cost differential between acquiring information about things going on in your own country, basically, versus things going on in other countries has greatly eroded in recent decades. We've got the web, email, phone, very cheap phone calls, travel is cheaper, kind of a coalescence around English as the international business language, and so on. One of the things I think so that in essence means you're not at the same kind of information disadvantage as a speculative investor, and as a portfolio investor, you feel more familiar and confident in the pricing of securities from abroad. I think one of the important things to notice here is that the effects of this kind of reduced cost differential have probably not been fully felt yet. That, learning how to effectively use newly available cheap information from abroad takes time. In essence, it requires feedback and experience on the reliability of the sources and the importance of different kinds of information. Related to all this, and I think with the same kind of lag, is that these same technological changes are slowly creating a more uniform social and economic culture globally. So that both means that, what's happening abroad may be more similar, but more importantly, your understanding of what's happening is better because your perspective, your understanding of what's going on somewhere else is easier if what's going on somewhere else isn't as different in some sense as what's going in your own country. And that more uniform social and economic culture developing for lots, right? Transnational mass media, transnational marketing, education across national boundaries, scholarly research. Here I am. Professor Gu has been at Columbia, and just direct personal interactions. So all of this is, in essence, bottom line, reducing an investor's disadvantage in understanding the factors that affect the future cash flows of foreign issuers. Okay, so, bottom line so far is that information concentration reason for home bias has eroded. Now let's look at a couple of the other impeding factors. One of them is currency exchange risk. The reason people invest is so that at some point in the future they can consume. Most of your consumption is done at home with home produced products and services. So there are lots of risks associated with investing in equities, but at least one of them, if I'm a U.S. resident and I invest in U.S. companies that produce a dollar cash flow, is I don't have to worry. I'm going to get dollars back. I put dollars in, I'm going to get dollars. That's not true when you invest in foreign issuers. It's one more factor, right, that can go up or down as exchange rates change. So that makes, people don't like risk, and that adds to the riskiness of investing in foreign issuers. But again, I think this this impediment, while still there, is eroding. There are a couple of reasons for that. One is kind of to realize that if you own some securities that will produce cash flow in a foreign currency, that can act as a hedge against the effects of changes in exchange rates on your consumption of foreign goods. So let's say I have a fondness for French wines. If I invest in companies that produce cash flow in euros, so suppose that the dollar weakens against the euro. Well, I'm not happy about that as a French wine drinker, but if I've invested in stocks that pay me in euros, I am happy about that change from my euro investment point of view, because that weaker dollar means I'll be getting more dollars for each euro. So also, I think, currency futures are more complete and less expensive than they used to be. And within the Eurozone, a major economic area relative to 30 years ago, the euro has completely eliminated this kind of risk. And then finally, let's talk about taxes and regulations. So first, currency control and tax measures can severely discourage cross-border investment. If you put money in and then you can't get it back out, why did you put it in the first place? These kinds of controls were, very common after World War II. Many of the world's advanced economies put them in place, but they've been large across that sector of the world economy, largely dismantled in the 1980s. And I think competition for financial services makes it very unlikely to return. Now, I don't have to tell people in Hong Kong that they haven't exactly disappeared entirely, and including not in some very large economies, including obviously China, but still that impediment for some significant part of the market has disappeared. Other regulations can affect things as well. Basically, securities regulation can be a serious impediment. It's much more convenient and easy to invest in foreign issuers if they're being traded on a domestic stock exchange. If you want to, let's say, if I want to purchase shares on the Paris Bourse, so that I can have a hedge against my French wine risks, the only way I can do that, the French Bourse only allows French broker dealers to execute orders, but those broker dealers are not allowed to be operating in the United States. I have to, in essence, use two broker dealers with the additional costs. Alternatively, that French company could be offering its stock on the New York Stock Exchange, but then it has to comply with the disclosure regulations, both in the United States and in France. Again, though, if you looked at, this is an area I worked in considerably over the years, if you look at kind of trends, these trends have eased relative to the kind of barriers they used to create. Okay, so now let's move on to, having established this context, the interaction of foreign ownership and corporate governance. And I'm going to focus on a particular aspect of corporate governance. I mean, there isn't full agreement about all aspects of corporate governance, and in essence, what constitutes good corporate governance and what doesn't. So my focus is going to be on what I call portfolio supportive corporate governance, and I'm going to define that in a moment. But my focus there is because that's the aspect of corporate governance that I think is going to be related to foreign ownership. And I think all things equal, most people would think that it's an aspect of corporate governance that is positive. So let me start with a starting point that may seem a little bit off, but I think you're going to see where I'm going in a moment. And that is that in an efficient securities market, the share price of stocks reflects an unbiased prediction of the future cash flows of the companies trading on that exchange, discounted to present value. The cash flows that will be coming to portfolio shareholders, ordinary shareholders. If the control shareholders or others associated with a company engage in diversions of the cash flow that is generated inside the company, so that in essence, shareholders don't get a pro rata share of what is generated, portfolio shareholders. Well, okay, might not think that's great, but the fact is, okay, if I know that company X is going to have cash flow of $100 million a year for the next 20 years, 20 million of it is going to be diverted, and the other 80 million will be distributed as dividends. It'll be priced accordingly. It'll be like a company that produces 80 million. And so that kind of, if we kind of do this first cut, it would suggest that the quality of an issuer's corporate governance shouldn't have any effect on the desirability of being a portfolio investors. That basically shares of poor governance issuers would have lower expected cash flows to their portfolio holders, but they'd be priced commensurately lower, so they'd be equally attractive to buy as a portfolio investor. But what that kind of leaves out is that there's an information asymmetry between the control shareholders of a company and its potential portfolio purchasers at the time of sale. And every company starts with control shareholders because every company is formed by an entrepreneur and some small number of backers. And that in turn leads to, what economists call a Lemons problem. If you don't know kind of the likelihood of diversion, and you have to guess at it, you're going to guess it's kind of average. It means the people who actually aren't going to divert very much are going to find, I guess it's not worth taking my company public, which then means there are no portfolio investor shares available to be owned by foreign shareholders. And that's the kind of thing that can really unravel a market. So in essence, then, a company that is viewed as having more effective constraints on insiders diverting cash flows has less of this information asymmetry associated with it, which then makes it, in essence, a candidate to go public. To go public, remember, it kind of takes two to tango. You can offer stock and people will pay some price for it, but that price has got to be, even if there's a lot of information asymmetry, but if that price is too low, insiders will, the original control shareholders say it's not worth going public. I'm not going to dilute for a low price. So it takes kind of better corporate governance than from this portfolio support corporate governance point of view to deal with that problem. So, let's now see how this little story I've told relates to foreign ownership and forces that can lead to greater foreign ownership. So the first thing is to recognize, probably everybody in the room knows this, that outside of the US and the UK, most publicly traded firms have control shareholders. And those control shareholders are in turn, in almost all cases, of the same nationality as the issuer. So that means, if you don't have if you're not a public company, there's not going to be I should back this up. If you don't have much of a free flow in sort of stocks that are available to be bought and sold on exchange as a public company, because it's not been very desirable to sell those shares from an insider's point of view, there aren't going to be very many shares to be available to be foreign owned. If you don't have very many portfolio available shares out there, portfolio holder shares out there, you're not going to have very much foreign ownership. So you can't have more portfolio shareholders without more foreign portfolio shareholders without more shareholders more generally. And I don't think I'm really addressing this talk to that kind of foreign ownership, because I think, large blocks of foreign ownership, that can happen. But those are typically, their governance aspects are really more contractual. They're not the kind of governance I'm talking about here. They're simply understandings between players. Now, what I've said there's been a weakening of forces impeding cross-border equity holdings. Exactly what's the relationship between that and in turn the relationship between foreign ownership and the increase in foreign ownership and corporate governance? Well, let's take this 2 steps at a time. So at any one moment, the demand for a country's shares abroad is going to be determined by 2 things. One, in essence, the strength or weakness of these non-corporate governance forces, what I've been talking about so far, and that the fact that today, as of today, those are a lot weaker than they were 30 years ago. The other factor is going to be the quality of portfolios supporting corporate governance in the country, because without that, you're not going to have the shares available to be held by foreigners. Now, but what about kind of dynamic in terms of what's going on over time? Well, what I'm going to argue is that the weakening of these kind of impeding forces is a catalyst for what turns out to be kind of a self-reinforcing positive relationship between foreign ownership and the quality of corporate governance. That better corporate governance is leading to more foreign ownership, and more foreign ownership is leading to better corporate governance. So I'm going to suggest we look at 3 pathways. So first comes the catalyst, weakening of these impeding forces. And what that says to the fact that weakening has occurred, in essence, means there's a bigger market of foreign equity investors out there potentially interested in investing in a country's issuers. And that means, in essence, there's a greater incentive to improve your corporate governance. Because a greater incentive both at the countrywide level and by individual issuers to the extent that they can impose on themselves constraints on diversions. Those incentives are bigger again because, in essence, there's a larger potential pool of capital abroad to draw on. Now, if you look at the evidence, first of all, it shows that there's a strong relationship between effective country corporate governance and basically bigger, deeper capital markets, and particularly foreign ownership. Here, in some sense, when we see, countries that have corporate and securities disclosure laws that are stronger and more effective, the direction of causation seems logically to go from laws to effect. Having companies that have a higher level of foreign ownership is not that likely to affect domestic legislation, but it's easy to understand. If you have better domestic legislation and enforcement, you could create this greater incentive. You could make yourself more attractive. You will have a larger portfolio shares to sell. There's also evidence in the empirical literature that effective individual firm diversion constraints are positively related to more foreign ownership. And there, the empirical studies, you can kind of tease out the direction of causation, that the direction of causation is at least partly from the greater constraints first to greater foreign ownership. And the second pathway is to imagine, there are countries with weak corporate governance to start with that decide, in essence, for their own reasons to improve that corporate governance, not because they see a big pool of capital out in the rest of the world that would be nice to tap in, just for their own reasons. And there are plenty of own reasons if if there was no outside capital to make those changes. And what might those reasons be? Well, Professor Gu may disagree with me here, but I think it's at least still positively in fact that there's been kind of more of a convergence, at least until very recently, over the last few decades towards a shareholder-oriented model, which then emphasizes the importance of having these diversion constraints. There's also the extent that having that better corporate governance makes you more efficient. There's with greater international trade, companies are competing with each other. They need a corporate governance system that makes them efficient, or they may lose out in that competition and shrink or disappear. Another reason is, as countries get wealthier, more people are saving for retirement, want to have an independent retirement, aren't just going to depend on their kids or whatever. And that creates a pool of money looking for things like portfolio investment. Again, that is a reason then to improve corporate governance unrelated to a pool outside. And then finally, there are theories that there's going to be much more appetite for portfolio investment in countries where there's less risk of government expropriation. If imagine you started a company and you're living in an environment in which basically the government could take it away without adequate compensation. Well, if you own a whole lot of it, then you also can maybe be a powerful political actor and defend yourself. If only a little bit of it, you probably can't. And so, it gives an advantage to privately held to a publicly held company in an environment where that's fear. When that fear goes away, again, it's a force for public, for having a larger portion of companies owned by portfolio investors. So, again, though, okay, here are a variety of reasons why a country, without ever thinking about a pool of capital abroad, might strengthen their corporate governance. But if they do strengthen their corporate governance, the reduction in those impediments is going to lead to greater foreign holdings. And then the third pathway, again, think of the weakening of the impeding forces as the catalyst. The weakening of those impeding forces, even if a country doesn't improve its corporate governance, will lead to greater holdings of that country's foreign holdings of that country's issuers. Not as much as if it improved its corporate governance, but the impediments have been lessened, and so there'll still be reasons to invest. And that, in turn, can lead, and we'll explore the reasons why in a moment, but that in turn can lead to those foreign shareholders influencing things so that there is improved corporate governance in the companies in which they invest. Now, again, there's empirical evidence that effective individual firm diversion constraints and indicators of a firm's good corporate governance are related to foreign ownership. And, again, just knowing that doesn't tell you that this direction of causation is working. It doesn't tell you that it's the larger foreign owners that are improving corporate governance rather than the improved corporate governance has brought in the foreign owners. But there are some reasons to think that more foreign ownership does lead to greater constraints. And the idea here is that foreign institutions from rich countries that themselves are countries that have kind of strong portfolio supportive corporate governance, those institutions, those kinds of funds, they have a domestic experience that leads them to have higher expectations. They're also less enmeshed than domestic shareholders in relationships with control shareholders. So they're basically more likely to push for corporate governance improvements in the companies that they invest in. And you might say, well, look, they're minority shareholders, so they might want better corporate governance, but what are their tools for obtaining them? Well, one obviously is they can threaten to sell, and control shareholders may still care what the what the price of the company's shares is in very trading markets. And obviously, in situations where somebody has control, but it's less than 50%, then the vote at the margin can be a threat. So let me conclude and kind of end with the theme that I started with, which is the last few decades may be the start of a quiet revolution. That first of all, we've seen a significant increase in foreign ownership. We've seen improvements in corporate governance, and we've seen reasons to think that there's a relationship between the two. And we also see that there are reasons to think that this catalyst, this drop of the non-corporate governance related impediments to foreign ownership, that that drop in impediments hasn't done its full work yet, and that those impediments will get less, which suggests if the catalyst is going to kind of get greater, we're going to see more of the other things that we've seen so far. So we see more of this reinforcing interaction between foreign ownership and governance that leads to significant governance improvements. But there's a caveat. Countries that impose barriers to foreign ownership can opt out of this process, and we know there's a tension between globalization and nationalization going on at the moment, and this may be on this.
Thank you, Professor Fox, for very interesting and very insightful analysis of the cause and effect of foreign ownership or increased foreign ownership on corporate governance. I find it really fascinating, but I have a few questions. One is,
I knew you would.
one is, I actually agree with your analysis that the three pathway, but I do have one tiny skepticism about your suggestion that foreign owners would push for, especially foreign owners from saving rich country, to push for higher corporate governance standards. You suggest that at the beginning, in one of the pathway, they might not care about the corporate governance standard of the company they buy, but once they buy in, they would, from their own experience with their own country's corporate governance standard, they will push for higher corporate governance standard. I think that sounds convincing in theory, but I'm just wondering, in practice, would they not just simply sell later if maybe they'll push for a higher corporate governance standard for a short while, but if they don't see any result, would they be tempted to just sell and get out of the market and move somewhere else?
Well, I'm sure that they would often, right? I think the underlying idea here is they may see opportunities to buy, even though it's poor corporate governance. They would have bought more if it had been good corporate governance, but still worth buying some. Once they're in, they make more money if they can reduce diversions than to sell the stock at a price reflecting a higher level of diversion. So it's worth pushing. Clearly, since they only have a limited number of tools available to them, threatening to sell may be one of the tools that they have. But, in this idea that, you can, the Wall Street walk or whatever, if you have the ability to influence the level of corporate governance. They'll be wealthier by sticking around and reducing the diversions than selling at a price that assumes a higher level of diversions.
And of course, pushing for higher corporate governance standards itself costs it raises the cost of investment as well. I mean, it costs money for them to push that.
Yeah.
So in the end, I guess it's a matter of analyzing the cost and benefit and to see what works better for them. Whether to sell or to push further the corporate governance standard.
Yeah, I mean, I think I've articulated rationales as to why it could occur. There is some empirical evidence that it does occur, and so this is an explanation.
Okay. The other question is, you mentioned exchange risk as one of the impeding factor that discourages foreign ownership.
I'm sorry.
You said exchange rates, risk,
Rates, yeah.
exchange risk is one of the factors might discourage foreign ownership. But on the other hand, could it be a double-edged sword? If you have control over the exchange rate fluctuations, either because you are large enough, you could control how the exchange market works, or you could predict how it's going to happen. Wouldn't you say that where there's risk, there's opportunity, and you might want to take advantage of the risk to actually invest more because you think it's going to work in your favor? Is that possible?
Well, I guess, I mean, in essence, what you're saying is if you want to speculate in future exchange rates, you could do that through equities. I just don't know, you also can do that by simply speculating in longer run currency contracts. So I'm not sure if that's what you want to do, that you do it through equities. But I suppose you think in addition to being smart about, what's a good investment company-wise, you're smart about what future currency exchange rates are going to be. And if you're smarter than the next guy, you can put the two together.
Yeah, for example, if you predict that US is going to raise the interest rate, for the next 6 months or whatever, and you think that the US currency is going to go stronger, you might invest accordingly.
Yeah.
So I mean, you're suggesting that it's a factor that discourages foreign investment, but I'm saying if it is possible for you to predict, it might actually works the other way. It could actually encourage you to sort of invest in foreign companies.
I think it's an interesting thought. I mean, the question is, again, in some sense, whether there's an efficient market in longer term exchange contracts. Because if there is, then you've got to be smarter than those contracts in terms of figuring out exactly what US or any other country's interest rate policies or other things are.
I'll just have one quick last question and then I'll open the floor. Your analysis in terms of the factors that encourages foreign ownership and factors that impede foreign ownership, do those factors apply to private equities as well? I suppose you're talking more about the investment through stock market, but do they also apply to private equity?
I think they would, but I mean, I think most of them would. I think we'd have to think through them all, but I mean, in some sense, private equity investors are making on a grand scale the same kinds of decisions that speculative investors are making on the small scale.
So on that note, can we thank our professor in the usual way for a very, very insightful analysis and a stimulating lecture. Thank you, Professor.
Well, thank you very much. Enjoyed it.